Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. The show this week's brought to you by my company, Bull Realty. For a great service selling apartments or any commercial properties, land, hotels, anything in the Southeast U.S., please do reach out to me personally. My email is michael@bullrealty.com. Well, speaking of multifamily, that's what we're going to talk about today. You know, multifamily has had a great rise over the last several years with great rent increases. It seems like we still have really strong demand for multifamily, but how is it performing now? What are cap rates doing? What are expectations and forecasts? Some folks are thinking there might be a little bit of distress as these higher interest rate loans come due. So let's see what's happening. Please welcome my guest is Carl Whitaker. Carl is Director of Research and Analysis with RealPage. Carl, good to see you, sir.
Yeah, good to see you, Michael. Good afternoon, and I guess twice in 2 weeks now. So good to connect with you again.
Yeah, it's awesome. So everybody's always curious about the multifamily. It seems like a real favored asset class right now, and has been for a while. How is performance really going? It seems like in the Southeast we've seen a lot of rent escalations just kind of slow down a good bit, or sometimes flatten. What's the real story?
Yeah, you keyed in on it perfectly there in the intro. You said that demand for multifamily appears strong, and it really is. And that's kind of counter to what you're seeing on the rent growth and occupancy side right now, where we just set a record over the past at least 20 years since RealPage has been tracking the space. We set a record for most demand in a first quarter, more than 100,000 units absorbed on net. And we're now on a trailing 12-month basis seeing more than 300,000 units absorbed on net. However, there's more supply delivering today than at any point since the mid-1980s, and because of that, you're seeing rent growth in many markets is flat at best. In fact, there's a lot of markets that are seeing year-over-year rent cuts. Occupancy in a number of markets is now at a 10-year low. So it's kind of counterintuitive that even though demand is getting back on track and in a big way, the performance readings aren't necessarily congruent with that. And again, it's pretty simple supply demand, just with so many units being added, that's compressing performance.
Are there any certain markets, Carl, that jump out performance-wise?
Yeah, so on the weakest side, it's many of the markets, again, counterintuitively, but the markets with the strongest demand, Austin, Jacksonville, Dallas, Fort Worth, these are markets that are well above their 10-year average in terms of absorption. But again, they're delivering, in some cases, north of 10% of all existing inventory is being delivered over the past 12 and upcoming 12 to 18 months. On the opposite side, you're seeing stronger performance. I don't want to necessarily say strongest, because it's not necessarily that rent growth is excelling, but 2 to 3% rent growth is happening in Boston, Chicago, Washington, D.C., many markets where you're not getting as much new supply delivering. And it's a pretty simple takeaway there, again, just that balance of supply demand. So on the upper end of the spectrum, call it 2 to 3% rent growth is leading the country. On the bottom end of the spectrum, a number of the small coastal Florida markets, Austin, Jacksonville, Orlando, et cetera, you're seeing rent cuts of 4, 5, 6% year over year.
Wow. Well, it seems like it was bound to happen with the 10% plus rate increases we were having. Since I'm headquartered here in Atlanta, what do you see for Atlanta?
Yeah, I think that's a big explanatory factor too, just that, again, economics 101, what goes up must come down, and oftentimes that's at a fairly congruent pace on the up and the downswing. Now, the good news is that on a trended perspective, rents today are, still kind of in that ballpark of where you would have expected them to be over a 5 to 10 year hold had you purchased in 2019 or 2020. Now in Atlanta, we're seeing that demand is strong. There's a lot of supply. I'm preaching to the choir there. You see it all around you there in the Atlanta metro. But I think the biggest challenge that we're seeing in Atlanta is actually on the rent collections side of the equation. RealPage data shows that 92% of all billed rent in the Atlanta metro was collected over the past couple months, and in most markets that's closer to 94, 95%. So I think there's some underlying collection issues, mainly with Fulton County. I think that's skewing a little bit of the overall Atlanta MSA, but collections kind of seems to be the thorn in the side of Atlanta operators currently.
No, that's interesting. And then I guess occupancy kind of runs similar trends.
Yeah, occupancy is looking at about 91, 92% across the Atlanta metro. Now, to your point earlier on some distress emerging, there are some submarkets, particularly the more workforce housing oriented submarkets where more Class C properties are going to be prevalent. We're seeing occupancy in some of those pockets is dipping into the upper 80% range. Now, this is where market segment really matters. When you look at the Class A properties, say in Buckhead, you're still looking at 93% occupancy, not necessarily out of line with historically normal. And again, a lot of that's just a simple supply-demand equation where even though that's where most of the new supply is delivering, that's where most of the demand is being channeled as well.
Yeah, and in Atlanta, for example, we don't seem to see a slowdown in new supply. What's the real story there in Atlanta and then around the country? Is new supply still running rampant?
Yeah, so the realized supply today certainly isn't slowing down. You're seeing more lease-ups hit the market than we ever have since RealPage has begun tracking the market. But in terms of new multifamily starts, you are seeing a big pullback. So it's not going to be too long before we see the number of units actually delivering starts to ease and, ease pretty significantly. Some of these markets like Atlanta, new starts activity down 40% year over year. And in fact, are starting the same number of units today as what you would have expected in again, call it normal year in the 2010s. So I think by 2026, certainly by 2027, a number of these markets are looking at, again, kind of a healthy supply-demand balance. Now, a lot of this assumes that the demand side of the equation stays consistent, but we don't have any expectation that apartment demand is going to slow down anytime soon.
Yeah. What about cap rate trends, Carl, for multifamily properties?
Yeah, and you and I caught up a little bit about this when we were preparing for today's discussion. Cap rates have come up from the low point in 2022. At the lowest point nationally, the average cap rate was about 4.5%. Today, cap rates are at about 5.2%. So they have come up off of that low point. 5.2% kind of puts you back where you were at, call it 2019. So we're starting to get to a more normal environment on that perspective. I think what's not normal, however, is that the composition of properties trading today is kind of a mixed bag. And what I mean by that is you're seeing a lot of distress starting to emerge at the lower tier product spectrum. A lot of Class C distress happening in some of these markets. I don't know how much of a baseline that really gives investors for where middle market pricing is or should be. And then you're starting to see a little bit of movement in some of the big institutional deals. The Blackstone ARR merger was huge news coming out here recently. But again, that's the other end of the spectrum where it's, ultra luxury, Class A, downtown, coastal markets. It's kind of, it's hard to pin where that middle part of the market should be from a pricing perspective. So I think we still got some discovery in terms of cap rates where they ultimately land, interest rates obviously being a big part of that equation. And I'm sure we'll talk about interest rates here in a second, but cap rates have come up, but not necessarily at a point that we haven't seen before in recent years at the lower 5% range.
Yeah, I see that too for some of the nicer, newer properties. And to your point, yeah, I think cap rates and pricing guidance today is very, very individual to the actual property, right? I've even seen some folks in the industry in practice are talking about average cap rates and then their property. And I'm like, wait a minute, I wouldn't do that. Your property is unique. And so let's look at your property and its competition and its forecast individually, right?
Yeah, absolutely. And I think that's another key point is that the property level fundamentals can and do differ so much. Now, the good news, one last point too, while we're on this topic, the good news is that investor appetite hasn't gone away. It's not like the apartment space isn't still if not the most desired space for investment. However, cap rates are a bit of a headwind right now, to say the least. And again, I think we're just seeing some pricing discovery unfolding as the market's kind of working back to a point of normalization after 4 years of anything but normal fundamentals.
Yeah. And I guess one of the reasons multifamily tends to perform well is the agency financing, right? Freddie and Fannie. What are you seeing for financing trends in multifamily today?
Yeah, that's absolutely spot on. We're seeing that the agencies make up or are making up a bigger share of financing today than they have over the past couple years. I think that you're seeing that translate now to construction as well, where construction financing is the biggest reason, or the inability to secure construction financing, I should say, is in fact the reason why you're seeing new starts pull back. It's not because the appetite for starting new apartments has gone away. It's just deals aren't penciling necessarily with where interest rates currently are. So I think that's a general overview of what we're seeing on the financing side of the equation.
Yeah. Anything jump out in your research, Carl, related to maybe office properties being converted to residential, or anything impacting the market kind of in a strange way?
Yeah, it's a really interesting question, and I think we're going to see what happens with some of these properties that are being converted. Generally speaking, it's still more anecdote than it is broad, widespread trend. But I know down in the financial district of New York, there's a big conversion happening where I think this quarter, if I'm not mistaken, I could be wrong on that, but here pretty soon, you're going to start seeing some move-ins to a property that's now residential being converted from office. So I still think overall it's going to be more of a limited phenomenon than it is widespread. But if some groups do find success, then maybe we start to see a little bit more of that happening. I think the biggest thing is it's just going to be so market specific, where in Atlanta, maybe it doesn't make as much sense of that office to residential conversion as, say, in New York, where there's, more of an overall shortage of housing.
Right. And Carl, what are some of the headwinds that the multifamily sector could face moving ahead?
We're hearing a little bit about slowing job growth. I'm not necessarily too concerned about that because you're still getting positive job growth on a year-over-year basis. We hear a lot about a population cliff, where your most common age in the country right now is 32, 33 years old. Well, conventional wisdom says, okay, those are the folks getting ready to move out of apartments into single family. I don't see that happening, so I don't think the population cliff that some folks cite is nearly as much of a headwind as what's being proposed. In fact, I don't think you really see a population cliff materializing until you're talking 20-ish years down the road. So there's no significant demand headwinds in the market. Now, the biggest performance headwinds through 2025 and really even 2026 is, again, going to be supply. We're seeing lease-up properties, for example. Their average asking rent, not even the effective, but the asking rent, has gone back to where it was in 2021. So asking rents have come down over the past 2 years simply because of the amount of supply being added. Developers are having to get competitive. Concessions are going up. It's a lot of properties competing for not as many renters, considering how many new units are being added. So I think supply is going to be the biggest headwind. We don't necessarily see too many economic headwinds unfolding. Obviously, that's always a possibility. And then finally, on the investment side of the equation, interest rates remain a headwind. This maybe won't be the most popular opinion over the next couple months, but I do think we're seeing a more realistic environment of maybe no interest rate cuts in 2024, because some of those inflation metrics are still running a little bit hotter than I think what the Fed wants to see. So interest rates from an investment side, maybe that remains a little bit more of a headwind.
Yeah, well, I try to share with folks that haven't been in the business maybe as long as I have, that these seem like more historically normal interest rates. So we have certainly helped clients make a lot of money with much higher interest rates. So business can still happen, right?
Right, and I think that's important context, because we got used to an environment that was abnormally low in terms of interest rates. So to your point, we can still make things happen. It just with economies and how they evolve, so does your strategy, so does your process, so does your expectations.
And there's always opportunities. We're starting to see some multifamily, and to your point earlier, B and C type stuff that's really good deals coming available that, the sellers are just a little distressed, or the lenders. We do a lot of lender work here at Bull Realty for all kinds of properties, and we're starting to see lenders, I'm sorry, we're gonna work through this, and we're either gonna short sell it if we've got clear title and an agreeable borrower, or we're just gonna foreclose and wipe it out if we don't have those things. So we're starting to see some more activity with properties becoming available. I know a lot of distressed buyers kind of, ringing. They're happy about this. They're excited. They're licking their chops, right?
And again, that goes back to the appetite side of the equation. The appetite is still there, and I think that that's a key thing to keep in mind going forward. Is that people still want to get these deals done. We're just kind of at an interesting point of discovery still happening on where prices realistically are and should be for the next couple of quarters.
Yeah, and I like your point. While new supply can be a headwind at the moment for some of these markets, overall it should be a tailwind, right? As these new supplies starts slowing down some, and then of course there's not much B and C being added to the market ever.
Yeah, yeah, and on that last point there, I would add something too that I think this is where the Southeast, the Sun Belt, some of those desert and mountain states, Idaho, Utah, etc. I still think that that's going to be the stronger growth economies for the long haul, partially because you are adding new housing. Now, granted, here in the near term, we're going to see performance compressed, but that supply headwind is really only going to be a 2-year phenomenon. As you move forward, those markets will still add new supply. And oftentimes, I think the availability of housing in those markets is one of the things that helps corporations relocate. It helps renters move to those markets, and single family households, for that matter, move to these markets. So we still lack the long-term demand side of the equation in the Sun Belt. And I think if you're investing, you're probably not investing on a 2-year horizon. You're probably looking at a 5, maybe even 10-year hold period, or realistically somewhere in between. And because of that, the demand, the structural demand drivers are something that should remain in place for some time. The supply headwinds is more of a cyclical phenomenon. And, as you've been in the business for long enough, you know that the cyclical things come to pass. The structural things are generally what holds for the long haul.
Yeah. Yeah. And I'll add, for the folks that maybe haven't been around as long as me as well, I'm sounding like an old man now, and I am, I guess, so I can sound like one, renting is not a faux pas anymore. It's like you're at a cocktail party a couple decades ago and somebody said they're renting and you felt sorry for them. They weren't doing well, and now you feel sorry for yourself, as they didn't have to work in the yard or deal with contractors selling their house this weekend, right?
Yeah, you've got summer coming up there in Atlanta, so you're gonna think about that whenever you see some yard work being done. But yeah, it really is a good point that the stigma of renting, if you will, that's changed over time. We're seeing a growing share of what we call lifestyle renters. Those are the renters by choice. That's becoming more and more common. And again, as economies and as demographics evolve, we've seen the rental housing industry do the same. And it's tough to get into the market right now, or at least grow portfolios based on where interest rates are. But that demand side is so important to focus on, and that demand side has really changed over the past couple of years, and I think changed for a more positive way.
Yeah. One thing I'd like to see with architects and new development is, the square footage is the size of these rooms is on these new builds are just so small. It's like, hopefully there's some room for some product with larger square footage. I don't know.
Yeah, it'll be interesting to see, because I know some of that comes down to density requirements from municipalities that are really dictating, hey, you need X number of units, and you've got a finite Y number of acres that you can develop on. So some of that's a legislative or a policy-based thing, but I think with work from home becoming more common, and like you said, as renters age into those cohorts where historically they would have been moving to single family, so their space requirements are going to change. So maybe we'll see a little bit of change there, a little bit of movement, but those are some of those things that tend to happen and unfold over much longer periods of time.
Yeah, well, good point and good information as usual, Carl. Thank you for joining us, sir.
Perfect. Thanks, Michael. Always a pleasure.
All right, thank you. And if you like more from them, visit realpage.com. They They track the market, and they also have a lot of services for apartment owners and managers, so do check them out. And do share this show. Please connect with us on your favorite social media. Reach out if you'd like to me for anything, and please share the show and pay it forward. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bullet Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. And by Lument. For senior housing, healthcare, and multifamily financing, visit lument.com. For more podcasts and videos, subscribe and visit creshow.com.